Why is it that Canada's annual inflation rate slowed down to a mere 0.7% in December of 2021? This question might be lingering in the minds of those who follow economic trends. Let's delve into this by examining some recent news articles. According to a Reuters report from January 2021, the slowdown was lower than market expectations and down from 1% in the previous month. This was largely attributed to new COVID-19 lockdowns and a decrease in the costs of airplane tickets, clothing, and footwear. Interestingly, consumer prices fell 0.2% on the month, with the cost of food included in that drop. What's more, the Bank of Canada decided to keep its benchmark interest rate unchanged at 0.25%, stating that it did not expect inflation to reach its 2% target until 2023. However, the central bank noted that the arrival of effective vaccines and fiscal and monetary policy support have improved the medium-term growth outlook. Two of the three core measures of inflation also fell in December. Ontario and Quebec, the most populous provinces, implemented stricter health restrictions due to the spread of the coronavirus. Meanwhile, investors in U.S. interest rate options are betting on an earlier-than-expected monetary tightening by the Federal Reserve to combat high inflation, as reported by Reuters in October 2021. This has led to increased volatility in U.S. swaptions, which are options on interest rate swaps. Rising inflation expectations and higher oil prices have contributed to this ambitious rate outlook. The market is pricing in aggressive actions from the Fed, drawing parallels with other central banks that have signaled rate hikes. On another note, Federal Reserve policymakers are expected to forecast strong economic growth in 2021, with falling unemployment and rising inflation, due to the COVID-19 vaccination campaign and a $1.9 trillion relief package. However, the Fed is unlikely to change its monetary policy stance and will maintain a dovish tone. In conclusion, the inflation rate in Canada is influenced by a multitude of factors, ranging from pandemic-induced lockdowns to changes in consumer prices and monetary policy decisions. While it's clear that the rate has slowed down recently, it's also evident that the situation is volatile and subject to change. So, it's essential to keep an eye on these developments and make financial decisions accordingly.